The next category of ratios that we need to look at is capital structure and solvency ratios. And these ratios analyze the composition of the entity's capital, or in other words, the mix of debt and equity in financing the assets of the entity. Now guys, debt is cheaper than equity for two reasons. First, interest is tax deductible. So when the company performs their tax return, they get a tax deduction for interest, and it reduces the amount of tax that they need to pay across to SARS, making debt cheaper than equity because dividends are not tax deductible. In addition to that, the providers of debt capital are exposed to less risk than shareholders. Why are debt providers exposed to less risk than ordinary shareholders? First, guys, interest and capital payments must be made regardless of financial performance. So even if the company has a bad year, they still have to pay interest and capital on any debt. However, if they have a bad year, they don't have to pay dividends. So shareholders are exposed to much higher risk because they don't know whether they're going to get a dividend or not. In addition to that, in most instances, debt is secured against assets, meaning that if the company does default on interest or capital payments on debt, the debt provider can repossess the assets so that they can recover what they've lost. On the other hand, ordinary shareholders don't have that kind of security. Further, if the company is liquidated, debt providers will rank above ordinary shareholders. So debt providers are exposed to less risk. And remember the relationship between risk and return? If they are exposed to less risk, they will be prepared to accept a lower return. So that makes debt cheaper than equity. And because debt is cheaper than equity, one of the advantages of debt is a company can use debt to improve returns to their shareholders because it's cheaper than equity. However, the disadvantage of having debt in your capital structure is interest and capital repayments on debt must be made regardless of financial performance. So debt exposes the company to financial risk. Now, if a company has too much debt in its capital structure, the debt providers are going to want to be compensated for this financial risk. Because once again, remember the relationship between risk and return. If the company has a lot of debt in their capital structure, there's a higher risk of default. So the debt providers are going to charge a higher rate of interest to compensate them for this risk. So you'll see, the debt providers expect to be compensated for this risk. So they may charge a higher interest rate, which will result in increased finance costs for the company. In addition to that, the debt providers might also impose additional loan covenants. So guys, loan covenants are just restrictions that debt providers put on the company. So for example, the debt provider might say, whilst the loan is outstanding, you can't pay any dividends. Or whilst the loan is outstanding, you need to maintain a certain interest cover ratio. So obviously debt providers do this to protect themselves and to try and limit the risk of default. They're trying to make sure that they actually get their money back. All right, so there's both advantages and disadvantages to having debt in your capital structure. Debt is cheaper, so it can be used to improve returns to shareholders. However, debt brings financial risk, which means that could result in increased interest rates from debt providers and also additional loan covenants. So that is very important, or that understanding is very important when it comes to the discussion of the ratios that you've calculated. Please note, when performing all of these ratio calculations, you should use market values and not book values. So you shouldn't be using the book value of assets, debt, and equity. Instead, you should be using the market value of assets, debt, and equity. And guys, please note, this is extremely important. If you make the mistake of using book values instead of market values, you will not score any marks for your calculation. So if you do have market values in the question, you must use market values. Then please note further, you should only include permanent sources of funding in these calculations. You'll see when we get to the ratio calculations, we use total interest-bearing debt in a lot of the calculations. And total interest-bearing debt includes the short-term portion of long-term debt, but it excludes the company's bank overdraft. Now, I want you guys to think about this logically. Think about the statement of financial position. We have non-current liabilities, which might include a long-term loan. Then we have current liabilities, and that could include accounts payable, it could include the company's bank overdraft, and it will also include the short-term portion of this long-term debt. Okay, obviously it can include other things as well. I'm just using this for illustration purposes. So for now, please assume we are the company and this is what their statement of financial position looks like. Now guys, we split this out for disclosure purposes. We have to do that. The long-term portion of the long-term liability will be sitting under non-current liabilities, and the short-term portion that's going to be repaid in the next 12 months is sitting under current liabilities. That's the current portion. However, total interest-bearing debt includes both the long-term and the short-term portion. Don't exclude the short-term portion just because it's sitting under current liabilities. That is long-term debt. It's only been split like that for disclosure purposes. All right. So total interest-bearing debt includes the short-term portion of long-term debt. However, if the question is silent, you should not include the company's bank overdraft in interest-bearing debt or total interest-bearing debt. And the reason for that, guys, is if the question is silent, remember, a company's bank overdraft is used for short-term working capital purposes. It is not a permanent source of funding. So if the question is silent, do not include the bank overdraft in total interest-bearing debt. However, you always need to read the information provided in the scenario because there might be exceptions. And if they specifically tell you in the question that the company is using their bank overdraft as a source of permanent funding or as a long-term source of funding and not a short-term source of funding, then you would include it in this calculation. All right, so that's where the unless told otherwise comes in, because there's always exceptions in management accounting. So if the question is silent, you exclude the bank overdraft because it's used for short-term working capital purposes and it is not a permanent source of funding unless you are specifically told otherwise. Then, in addition to the various ratio calculations which we are going to look at now, depending on the marks available in the question, you can also calculate movements. So if you have a question and you've performed all of the ratio calculations below, but there are still marks available, you should then calculate movements. And remember, we calculate a movement by taking the current year, subtracting the prior year, and dividing by the prior year. So the first ratio that you need to be able to calculate under capital structure and solvency ratios is the gearing ratio. So I've included the interpretation. The gearing ratio indicates the degree to which the entity's operations are funded by debt. So in other words, guys, if we get an answer here of 40%, that means the company's operations are funded by 40% debt and 60% equity. So the benefit of the gearing ratio is it gives us the capital structure of the company. How do you calculate the gearing ratio? we take total interest-bearing debt, and remember we said above, total interest-bearing debt includes the short-term portion of long-term debt, but it excludes the bank overdraft unless you are specifically told otherwise. We divide by total shareholders' equity plus total interest-bearing debt. And remember, guys, this should not be calculated using book values. If market values are available, you should use market values. So you are using the market value of interest-bearing debt and the market value of equity in this calculation. Then the next ratio is interest-bearing debt to equity, or sometimes also just referred to as the debt to equity ratio. And you perform this calculation by taking total interest-bearing debt and dividing by total shareholders' equity. Now, once again, guys, this calculation should be performed using market values and not book values. And one limitation of the debt to equity ratio is this ratio does not give us the capital structure of the company. So let's say, for example, you perform this calculation and you also get an answer of 40%. All right, I'm just using random amounts here, guys, for my discussion purposes. If you get an answer here of 40%, that does not mean that the company is funded 40% debt and 60% equity. Look at what's going into this calculation. If you have an answer of 40%, that just means that your interest-bearing debt is 40% of equity. It doesn't mean that the company is funded by 40% debt and 60% equity. So the benefit of the gearing ratio is the gearing ratio gives us the capital structure of the company. If we get an answer of 40%, that means that the company's operations are funded by 40% debt and 60% equity. A limitation of the debt to equity ratio is this does not give us the capital structure of the company. It just tells us what percentage debt is of equity, because you are just taking debt and dividing by equity. However, why is this ratio included if it has this limitation? You'll see sometimes in questions, guys, for benchmarking purposes, when they give you the industry average, they might not give you the gearing ratio for the industry average. They might give you the debt to equity ratio instead. So obviously, if they give you the debt to equity ratio with the industry average, you need to calculate the debt to equity ratio for your specific company so that you can make the comparison for benchmarking purposes. In addition to that, you'll see all three of these ratios above can also be benchmarked to the target capital structure of the company. Why would we benchmark these ratios to the target capital structure of the company? Remember, guys, the target capital structure is the optimal capital structure of the company. That is what they are trying to achieve in the long term. So whenever the company raises new finance, they'll always try and move closer towards their target capital structure. So when you are performing all of these calculations, using the gearing ratio, we can calculate the company's current capital structure and we can compare it to the target capital structure and see if they are better or worse than the target. So that's why the target capital structure can also be used as a benchmark. Now, please note they might also give you this target capital structure as the debt to equity ratio instead of the gearing ratio. So once again, for benchmarking purposes, if they give you the debt to equity ratio as the target capital structure, you will obviously need to calculate the current debt to equity ratio so that you can compare it to the target and you can discuss if it's better or worse than the target. So that's why we don't only look at the gearing ratio. You do also need to be able to calculate the debt to equity ratio just in case the benchmarking information, the industry averages, the target capital structure, that might be given as a debt to equity ratio instead of a gearing ratio. But please do just note that limitation over there. Then the next ratio is actually very similar to the debt to equity ratio. The only difference is we are now looking at the net interest-bearing debt to equity ratio, which means we need to deduct cash and cash equivalents from interest-bearing debt. That's the only difference between the two. But you should still be using the market value of interest-bearing debt and the market value of equity in your calculation. Then the next ratio is net interest-bearing debt to EBITDA. So obviously that is your net interest-bearing debt. We already saw that above. We take our total interest-bearing debt and we deduct cash and cash equivalents to get net interest-bearing debt. And if it's net interest-bearing debt to EBITDA, we are dividing by EBITDA. So not a difficult formula to learn. Here's your interpretation. What does this ratio tell us? It indicates the entity's ability to repay their debt from their current EBITDA. So is there enough EBITDA available to repay their debt? And guys, once again, you can see the interpretation comes directly from the ratio. Look at what's going into the ratio. That will help you with the interpretation. We are comparing their net interest-bearing debt. So total interest-bearing debt minus cash and cash equivalents, because obviously whatever money the company has sitting in their bank account, they can use that to settle their debt. So we are looking at the net amount that would be outstanding after they've used the cash and cash equivalents or the money that's sitting in their bank account. That is the net amount that's outstanding, and compare that to EBITDA. And you can then see if they have enough EBITDA to repay their debt. Then the next ratio that you need to be able to calculate is the total debt ratio. So here's your interpretation. This ratio indicates the percentage of assets that are financed by debt. So we take total debt and we divide by total assets. Just as a recap, guys, remember please that should be the market value of interest-bearing debt in the calculation above, and this should also be the market value of debt and the market value of assets. Please note over here, we are not using total interest-bearing debt, we are using total debt, all debt. So this is the sum of your non-current liabilities plus your current liabilities. Total debt, not only interest-bearing debt, all debt. In addition to that, how can you calculate the market value of total assets? Remember, guys, think of your statement of financial position and the reason why it balances. If you've performed all of your calculations correctly, your total assets should equal the total equity and liabilities. So if we need to calculate the total market value of assets, we can take the market value of equity plus the market value of liabilities, and that will give us the market value of assets. So we perform this calculation. If you don't have the market value of assets, you perform this calculation by taking the market value of equity plus the market value of debt. However, if you are given the market value of assets, you should rather just use the market value of assets. So you only calculate the market value of assets like this if you have not been given the market value of assets. Obviously, if they tell you the market value of assets, use the market value of assets that's been given. If it's not given, you can calculate the market value by taking the market value of equity and adding the market value of debt. All right, so once again, if you look at the interpretation, you can see we are comparing total assets to total debt. So this ratio tells us the percentage of assets that are financed by debt. So if you get an answer here of 30%, that means 30% of the company's assets are financed by debt and 70% are financed by equity. Then the last ratio in this category is interest cover. So once again, there's the interpretation. The ratio indicates the likelihood that the entity will default on interest payments. And you perform the calculation by taking EBIT and dividing by total finance costs. So guys, if the company has a very high interest cover, then it's not likely that they will default on interest payments because they have more than enough EBIT available to make those interest payments. However, if the interest cover is very low, then there's a higher risk of default because they might not have enough EBIT available to cover the finance costs. Please just note, when discussing this ratio, guys, this should always be considered together with the cash flow position of the company. And what is the reason for that? A company might have a very high interest cover. Let's say they have an interest cover of 5 times. So that means EBIT covers the finance cost 5 times. So the company has more than enough earnings available to pay their finance costs, and it's unlikely that they will default on those interest payments. However, just because the company has enough earnings available doesn't mean that there's enough cash sitting in their bank account. Because remember, there's a difference between profit and cash. So be careful. A high interest cover does not mean that there is sufficient cash available to make the interest payments. All right, guys, so those are all of the ratios that you need to know under the heading Capital Structure and Solvency Ratios. Please refer to the lecture example to practice these calculations.